There's a certain beauty, isn't there, in the architecture of a discounted cash flow model. It promises order in the chaos of the market, a mathematical certainty in predicting future worth. We pour in our assumptions, our carefully researched projections, and out comes a number, a precise valuation that feels almost like truth. It's this precision, this illusion of objectivity, that draws so many of us in. We feel like architects of our financial destiny, building empires on a foundation of carefully calculated future cash flows. But as Warren Buffett wisely reminds us, when forced to pick between a wonderful company at a fair price and a fair company at a wonderful price, I choose the wonderful company at a fair price. The DCF, in its purest form, can sometimes lead us astray here. It can become so fixated on the asterisk fair price asterisk derived from a cascade of precise, yet inherently uncertain, forecasts that it risks obscuring the true essence of the asterisk wonderful company asterisk. We can become so lost in the weeds of our spreadsheets that we forget to look at the forest, the enduring strength, the competitive might, the sheer quality of the business itself. This is the critical investor's dilemma. We stand at the chasm, the elegant theory of discounted cash flows on one side, and the messy, unpredictable reality of business performance on the other. How do we bridge that gap? How do we ensure our sophisticated analysis doesn't become a sophisticated gamble, a complex justification for a predetermined outcome? The truth is, even the most meticulously constructed DCF models can harbor hidden mistakes. These aren't the obvious errors, the typos or calculation blunders. They are subtler, more insidious blind spots woven into the very fabric of the methodology. They are the assumptions we make without realizing, the biases we embed without intending to. They can undermine the integrity of our valuation, turning a tool of insight into a source of profound error. This is where we begin our forensic audit. We're going to delve deep to uncover the 9 critical blind spots that can transform a rigorous valuation into a risky proposition. We're not just looking at the numbers, we're examining the thinking behind them. We're going beyond the headlines to understand what's asterisk really asterisk driving the valuation. This journey is about sharpening your edge, about seeing what others miss, and about building wealth not on borrowed certainty, but on genuine, data-driven understanding. The terminal value. It's the colossal, looming figure at the end of our DCF projections, often accounting for 50, 60, even 80% of the entire calculated intrinsic value. It's the promise of what the business will be worth far into the future, a nebulous horizon we try to pin down with a single, elegant number. But here lies the first great pitfall, the black hole where accuracy vanishes, the garbage in, garbage out principle applied with a vengeance. Imagine building a magnificent skyscraper, a testament to your financial prowess, but resting it on a foundation of shifting sand. That, my friends, is what relying too heavily on a single, precise terminal value can feel like. A seemingly minor alteration in that long-term growth rate or exit multiple, a tiny adjustment that feels almost insignificant, can send the entire estimated intrinsic value of the company careening wildly. The entire edifice of your valuation becomes suspect, built not on bedrock, but on the whims of future speculation. We are often led to believe that a single, definitive terminal growth rate or exit multiple is achievable. We strive for that one perfect number. But the reality of our world, the relentless march of economic shifts, the constant disruption from competitors, the unpredictable tides of innovation, these forces make such singular precision an illusion. To cling to it is to ignore the very dynamism of business and markets. It's like trying to nail down fog. If so, what is the critical investor to do? The actionable insight here is to abandon the quest for a single point of truth. Instead, embrace a range, employ a spectrum of terminal value assumptions, perform sensitivity analysis, understanding how a small shift in your long-term outlook impacts the final number. More importantly, shift your focus. Don't just chase a precise number. Scrutinize the asterisk quality asterisk of the business's long-term competitive advantages. Does this company possess an enduring moat, a resilience that can withstand the test of time and disruption? That is the true bedrock. This practice, this embrace of a valuation range, is the margin of safety in action. When we over-rely on a single, speculative terminal value, we erode that vital buffer, and a prudent investment transforms, subtly but surely, into a speculative bet, the discount rate. It's the engine that drives the present value calculation, the mechanism by which future earnings are brought back to today's terms. Often, this engine is powered by the weighted average cost of capital, or WACC. It sounds precise, scientific even, a neat summation of a company's cost of debt and equity. But beneath this veneer of objectivity often lies a black box, filled with inputs that are far from gospel. Think of it like this. Imagine trying to predict travel time across a vast continent, but you only use a single, generic average speed. You're ignoring the mountains, the deserts, the winding rivers, the traffic jams. A standard, one-size-fits-all WACC does much the same thing. It fails to account for the unique terrain, the specific risks, and the distinct capital structures that define individual businesses. What works for a stable utility company might be woefully inadequate for a volatile tech startup. The hidden truth here is particularly potent in the cost of equity. It's frequently back-calculated, or worse, pulled from opaque industry averages that bear little resemblance to the actual risks an investor faces with a particular company. This is where the real danger lies, failing to capture the idiosyncratic risks, the company-specific challenges that can truly derail an investment. These are the risks that matter most to the critical investor. So, how do we navigate this? We must deconstruct the WACC. Scrutinize each component. Don't just accept the stated cost of debt. Understand the company's actual borrowing costs and its debt covenants. Question the beta estimation. Is it truly representative of the stock's volatility relative to the market? And critically examine the equity risk premium being used. Is it grounded in current economic realities, or is it an outdated relic? Consider, instead, developing a company-specific discount rate, a rate that truly reflects the unique risk profile of the business you are analyzing. Benjamin Graham's timeless principle of the margin of safety is directly compromised when the discount rate is too low. A lower discount rate inflates perceived value, and in doing so, it invites unnecessary risk, turning a prudent analysis into a gamble. Let's talk about the heart of the DCF model, free cash flow projections. We meticulously forecast revenue, then deduct operating expenses, taxes, and capital expenditures to arrive at this sacred number. The intention is noble, to predict the cash a business can actually generate for its owners. Yet, the inherent difficulty in accurately forecasting free cash flow, especially beyond a scant 3 to 5 years, is profound. When we extend these projections to 10, 20, or even more years, we are stepping into the realm of pure speculation. Consider this analogy. Predicting the exact weather pattern for a specific day to decades from now is a fool's errand. We can, however, speak with some confidence about the general climate of a region over that same period. The DCF, in its long-term projections, often attempts the former, when only the latter is truly realistic. We are trying to forecast a specific storm when we should be understanding the prevailing winds. And within these long-term forecasts, a subtle yet pervasive bias often creeps in. Over-optimism. We tend to assume smooth, uninterrupted growth, a gentle upward slope on our charts. We ignore the inevitable cyclicality of business, the disruptive force of new technologies, the ever-present threat of competitors eating into market share. These aren't minor bumps, they are fundamental forces that shape a company's destiny. The strategy for the critical investor, then, is to shift focus. Instead of fixating on a single, precise FCF number far into the future, concentrate on the asterisk drivers asterisk of that cash flow. What are the underlying engines of revenue growth? Are the profit margins sustainable? What are the true capital expenditure needs to maintain and grow the business? Stress test your projections. Run scenarios with more conservative assumptions for growth, for profitability, for market share. Because the critical investor understands a fundamental truth. Cash flow is indeed king, but it is the asterisk quality asterisk and asterisk predictability asterisk of that cash flow, not merely the projected number itself, that is paramount. A flawed projection, no matter how elegantly calculated, is merely a false king, leading you astray. One of the most critical failures in DCF valuation is the tendency to overlook, or at least deeply underassess, a company's competitive advantages. We call this the economic moat. This moat is the fortress that protects a business's profitability and market share from the relentless onslaught of competition. When we fail to consider the strength and durability of this moat, our DCF projections are built on fundamentally shaky ground. Think of it this way. We are essentially valuing a castle, but we're doing so without even checking for weak walls or the presence of a moat. We're projecting the future bounty of the kingdom, but ignoring its defenses. This leads to a hidden risk, a dangerous assumption that current market share or brand recognition will somehow persist indefinitely. We forget that in the relentless churn of the business world, nothing is static. Innovation, disruptive technologies, and aggressive competitors are always seeking to breach those defenses. The critical investor understands that a robust DCF is not merely an exercise in number crunching. It is, at its core, an exercise in understanding the asterisk business asterisk behind those numbers. This means integrating a deep, qualitative analysis of the company's economic moat asterisk before asterisk and asterisk during asterisk the DCF process. What are the sources of its competitive advantage? Is it a powerful brand that commands loyalty, proprietary patents that create a barrier to entry, network effects that make its platform indispensable, or perhaps significant cost advantages that allow it to undercut rivals? Once these moats are identified and assessed for their strength and durability, our projections can be adjusted accordingly. A company with a wide, deep moat deserves more confidence in its long-term cash flow projections and perhaps a slightly lower discount rate. Conversely, a company with a weak or non-existent moat is fundamentally riskier, regardless regardless of how rosy its projected free cash flows might appear on paper. Valuing a commodity rather than a truly defensible business is a recipe for disappointment. We fall in love with our spreadsheets. We meticulously craft them, pouring hours into ensuring every formula is perfect, every historical data point is accounted for. This can lead us into the dangerous trap of overfitting our discounted cash flow model. We create a picture of the future that is exquisitely precise, a perfect reflection of the past, but utterly unrealistic for the dynamic, ever-changing world of business. It's like a tailor meticulously crafting a suit for a mannequin that never moves, a suit that looks immaculate on display but would be entirely unwearable for a living, breathing person who moves, adapts, and changes. And in this pursuit of spreadsheet perfection, a vital tool is often neglected: sensitivity analysis. Many viewers perform it, yes, but often superficially. They might tweak one variable here or there, but they fail to explore the crucial interplay of key variables. They don't truly stress test their assumptions against a range of plausible scenarios. The practical steps are clear. We must systematically test the impact of changes in the core drivers of our valuation. What happens to the intrinsic value if revenue growth is 1% lower? If profit margins shrink by 50 basis points? If capital expenditures are higher than expected? If the discount rate ticks up or the terminal growth rate falls? By doing this, we identify the variables that have the most significant impact on our valuation. These are the variables that deserve our deepest scrutiny and the most conservative assumptions. Benjamin Graham, the father of value investing, constantly urged us to understand the business. This mistake, the allure of the spreadsheet, and the neglect of robust sensitivity analysis shows how easily we can become detached from that fundamental truth. We become enamored with the mechanics, the numbers themselves, rather than the underlying reality they are supposed to represent. This leads to a dangerous illusion of precision, a false sense of certainty, and ultimately an erosion of our margin of safety. We've journeyed through the intricate landscape of discounted cash flow valuation, uncovering the hidden pitfalls that can transform a sophisticated tool into a source of profound error. We've seen how the terminal value can become a black hole of speculation, how discount rates can mask unique business risks, and how our projections themselves can be clouded by an overly optimistic bias. We've touched upon the critical failure to assess the economic moat, the very essence of a company's defensibility, and the seductive allure of the spreadsheet that leads to overfitting and neglected sensitivity analysis. These are not mere academic points. They are the very real blind spots that can undermine an investor's quest for sustainable wealth. As Warren Buffett so eloquently reminds us, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The DCF, when wielded with critical insight, is not about finding a magical, single intrinsic value. Its true power lies in its ability to help us identify that wonderful company, the one with a durable economic moat, strong management, and predictable cash flows. And it helps us understand the fair price not as a precise calculation, but as a range, informed by a deep understanding of the business's underlying quality and its inherent risks. The DCF, at its best, is not a magic calculator spitting out a definitive answer. It is a powerful instrument for understanding *. Its true value is unlocked not by the final number, but by the rigorous, critical thinking process it compels. It forces us to confront uncertainty, to question our assumptions, and to deeply analyze the economic realities of the businesses we are considering. The goal is not perfect prediction, for that is an illusion. Instead, it is to cultivate a robust understanding of value and risk, built upon thoughtful analysis and a wide, unshakable margin of safety. So, your next step is clear. As you approach your next valuation, whether it's for a company you already own or one you are considering, apply these insights. Question every assumption, stress test your models relentlessly. Look beyond the simple mechanics of the spreadsheet and prioritize the business's underlying strength, its durability, its true economic moat, over mere numerical precision. This is the mindset shift of the critical investor, the path to building wealth not on shaky forecasts, but on the solid ground of genuine understanding.